Hi, I'm Jimmy. In this video, we're looking for the top Dividend Aristocrat stocks. Which ones look like they could be the most undervalued? We're trying to find dividend stocks that look like they're super undervalued. Now, we're going to use two different valuation methods. We're going to use the dividend discount model, and we're going to use discounted free cash flow. Now, one of the reasons that we're doing this is over year to date, a lot of us know the stock market is down quite big. Well, oftentimes dividend stocks do a bit better. So I think if we can find some of those to add to our portfolio, this could really help out our long-term gains. Plus, in the meantime, it could add some much needed cash flow. If we're curious, the S&P 500 year to date is down about 25%. NOBL is beating it by about 7%. So that's a good sign once the market does turn around. If we can beat the market on the downturns, we have a better chance of beating them when things turn higher. Now, before we jump into that, I just want to tell you real quick about a website that we're building where it'll make it quicker and easier to value companies and ultimately research different types of stocks. We've already built the beta version of our discounted cash flow calculator, and we're going to be, at some point in the future, we're going to be adding the ability for the website to calculate the value of dividend stocks using the dividend discount model. By the way, the dividend discount model could also be a good way to value ETFs, something like NOBL, the Dividend Aristocrats ETF. But down the road, we're going to be adding that feature as well as every other way to value different types of companies. So we punch in the ticker. Doesn't matter what ticker we punch in the ticker. The website will kick back the best ways to value those companies and what the fair value should be according to those different valuation methods. This should help guide us as to make sure we don't overpay for stocks, because as I'm sure many of us have seen, as the stock market has tumbled, if we overpaid for stocks, we get really, really hurt. Even if we bought stocks at a decent price, we'll see a pullback, but we'll be much better off once the market turns higher again. Okay, for now, let's jump into our Dividend Aristocrats analysis to see which companies could be the best ones. First, I think it makes sense to define what a Dividend Aristocrat company is. So there's a Dividend Aristocrats ETF, ticker symbol NOBL. In order for a company to get into this index or into this ETF, what the company has to do is they have to increase their dividend every year for at least 25 years. So clearly, there are stringent requirements to get into this ETF in general. Like I said before, this ETF is beating the stock market over the past year, which has been a bad year, because dividend stocks tend to do better in a stock market pullback, and that is held true for this entire ETF. But on top of having to increase their dividends, in order for a company to increase their dividends, they really have to have two things to value them the way we're trying to value them. First, stable cash flow. Stable cash flow, if a company has stable cash flow, using discounted cash flow makes a lot of sense. If the company has reliable dividends, and by definition, to get into this ETF, you need reliable dividends. If they have reliable dividends, well, that would make the dividend discount model a potential candidate as a valuation method. Okay, now, just so everybody's on the same page, the first question is, what is discounted free cash flow? And the definition of discounted free cash flow is, the goal of the calculation is to, what is the value of a company today? If we look out into the future, all future cash flow to the company, what is that worth today? I did a video on how to do this calculation if you're curious. I'll leave a link to that video in the description below. But essentially, it is project out into the future free cash flow. For the website that we're building, we use analyst estimates because projecting out isn't always the easiest. So might as well let them do the work for us. We use those analyst estimates and say, okay, taking that, we project that back to today. We discount that back to today. What's it worth? Ideally, we want to pay less than that. For the dividend discount model, it's a very similar concept with one key difference. So instead of how much free cash flow will the company generate, the dividend discount model looks at how much free cash flow will we get as investors. So discounted cash flow is great when we're projecting out how much cash flow the company itself will receive. Dividend discount model looks at how much of that are they paying to us? What is that worth to us as the investor? Now, I also did a video on how to perform the dividend discount model calculation. I will also leave a link to that video in the description as well if you want to know how to do the calculation itself. The calculations are not terribly complicated. It's more just gathering a good information for it. Okay, that being said, let's jump over to all of the companies in the Dividend Aristocrats ETF and see which ones look like they could be undervalued today. Okay, now just so everybody's on the same page with what information we're showing here, clearly we've got the ticker, symbol, and the company. Then we have the most recent price as of the making of this video. And then we have the fair value using the dividend discount model. That's what DDM is. And then the fair value of the company using discounted cash flow. But basically, what we're looking at here is that if you see a company that is highlighted in light green, like 3M as an example, well, 3M is undervalued using one of the valuation methods. If we see a company highlighted in bright green, the company is undervalued using both valuation methods. To me, those are the more interesting ones. Now let's run quickly through which ones look like they are undervalued using both methods. The first company is AbbVie, ticker symbol ABBV. AbbVie's trading about $140 per share. We have the fair value somewhere in the 160s. And AbbVie is a pharmaceutical company. Their biggest drug is Humira. Interestingly, year to date, even though the stock market is down nearly 25%, AbbVie's actually up about 6%, assuming we reinvested those dividends. So this could be a really interesting one. I could only imagine what this stock would have done if the stock market wasn't down so far. Although I would not be too surprised, I'm not terribly surprised that a defensive company like a pharmaceutical company would do well in a down market. But still, it looks like it could be undervalued. This could be a really interesting company for us to look at. Now, if you'd like for me to do a deeper dive, do a video on any one of these companies, please let me know in the comments below. Okay, next up, we got Amcor. Amcor is currently trading at about $10 per share. We have the fair value somewhere between $14 and $18 per share. Now, this is a packaging company. They make a lot of packages for the food industry, pharmaceutical industry, medical supplies, things along those lines. Over the past like 10 months or so, year to date, again, stock market's down about 25%. They're down about 9%. So not as good as AbbVie was, but still beating the market. And this could be another interesting company to consider from a research perspective. The 4.5%, almost 5% dividend could really make this a good Dividend Aristocrat stock for us to go out and consider buying. Okay, now we got Chevron. Chevron's a big oil and gas company. Now, when we look at the current price is about $158 per share. That's about in line with the fair value we got using the dividend discount model. But using discounted cash flow, well, we got a fair value of above $270 per share. Now, this was really interesting to me because all this would tell us is that analysts are fairly optimistic about free cash flow for Chevron in general. And I think that this could be a company that, despite the fact that these stocks have done fairly well through the entire year, well, these could be another company worth considering from a research perspective, because I think this could be an interesting addition to many of our portfolios. I don't have any exposure to any energy stocks in my personal portfolio. So this could be an interesting one for us to look at. Now, Chevron only has a dividend yield that's slightly below 4%, but that's partially because the stock is up nearly 40% year to date. So overall, this stock has done really well, and it's impressive that the stock could still have some upside here. So again, this could be an interesting one. Let me know in the comments below if you think we should analyze this one. Now, if we're looking for a real value play, Franklin Resources could be an interesting one. So this is a financial company that they make money, they make their fees from mutual funds. They have separately managed accounts, a lot of stuff to do with retirement accounts. And this could be an interesting value opportunity because this stock is way down. It's down like 38% since the start of the year. The good news about that is that it gives our current dividend yield at about 5.5%. So considering there could be some upside in this stock using both discounted cash flow and the dividend discount model, to jump in and consider buying this stock here could be an interesting one to research. Because again, if we jump in and buy it, I just want to clarify, if somebody were to jump in and buy this stock today, and let's pretend the stock moves higher. When the stock moves higher, the dividend yield will move lower. If you pay a higher price for the same dividend, the dividend yield will move lower. But the cost on yield is a very important consideration here. And that is that if we pay $10 for a stock and they pay $1 dividend, we're getting a 10% dividend. If that stock price goes to 20, well, we paid 10, we still get $1 dividend. So that cost on yield is very important to consider. So if we're interested in locking up about a 5.5% dividend yield at the current dividend level. Never mind the fact that for 25 consecutive years, they've increased their dividend amount. If they keep doing that, we should do better and better. So over the long run, this could be an interesting one to consider. And then the next company we got is T. Rowe Price. This is similar to Franklin Resources in that they're a financial services company, and the stock has been hit a lot over the past year. The stock is down nearly 50% year to date, which explains why their dividend yield is currently up near almost 5%. So again, we could get a decent dividend yield out of a company like this if we're looking at this one now. So I think that there's some real opportunities on a lot of these dividend stocks. And if you saw any companies that I didn't talk about that perhaps weren't green on both categories, and you think that, hey, this one's pretty close, this one looks interesting, please let me know in the comments below which companies you think we should go ahead and analyze, because I'm looking for some diversification to my portfolio. By the way, I recently did a video on my entire portfolio. If you're curious, link in the description below. And if you'd like to sign up to get access to the website to help you value different stocks, well, I will leave a link to that in the description below as well. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.